Hello, and welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. Today, I'm going to be discussing the ins and outs of the Qualified Charitable Distribution, or QCD for short. So I'll go through who's eligible for them, what they are, and then the next steps you should take if you want to build these into your overall financial plan. Many of our clients have charities or organizations that they like to donate to throughout the year. And because of this, I like to bring up the QCD strategy for those who it might make sense for. QCD is a way to donate directly to a qualified 501c3 charity from your IRA account, which gives you the ability to exclude the withdrawal from your taxable income for that year. For starters, only those who are RMD age are eligible to do a QCD. Generally, that means you must be over 73 years old in order to be able to do a QCD. But if you need a more detailed breakdown of RMDs, I encourage you to take a look at the Symmetry Spotlight video from April of this year, where I explain RMDs in more detail. Typically, if you take a withdrawal from a traditional IRA or any other tax-deferred account, that money is included in your federal taxable income for that calendar year. And that also goes for your required minimum distributions. With a QCD, we can take part or all of the required minimum distribution that you have to take for that year, and we can send it directly to a qualified 501c3 charity of your choice. In doing this, the IRS will allow you to exclude that withdrawal from your taxable income. This allows clients who are charitably inclined to donate to the charities they care about while also receiving some tax benefits for themselves. It could also allow you to make larger charity donations with even larger tax benefits for yourself. To elaborate on that, historically, only taxpayers that itemized on their taxes could deduct charitable contributions. But with the passing of the One Big Beautiful Bill Act, taxpayers that don't itemize are now allowed to deduct charitable donations, but that's limited to $1,000 for single filers and $2,000 for married filing jointly. So instead of donating directly to the charity out of your own pocket and being subject to the $1,000 or the $2,000 limit, you could do a QCD instead, which has an annual limit of $108,000 per person for 2025. So this could have a far greater impact on your tax return every year. This strategy only works if you are RMD age and you don't need that money to cover your normal annual living expenses. So as an example, let's say we have a couple whose combined RMDs are $20,000. They need $10,000 of that combined with their other retirement income to cover their expenses, but the remaining $10,000 they don't need could be used as a qualified charitable distribution. Logistically, if we process a QCD for a client, that money has to skip the client and go straight to the qualified charity instead. At our firm, we simply cut a check or do an electronic transfer directly from our client's IRA accounts to the charity they choose for whatever dollar amount the client requests. So it's nice and easy. So in summary, a QCD is a way for investors who are RMD age to be able to take some or all of their RMD that they don't need and use it to make a donation directly to a qualified charity of their choice. By doing this, you are allowed to exclude that amount from your taxable income for the year, which could give you some significant tax benefits. If you are eligible to make a QCD and you want to talk more about if this strategy could make sense for you, please give me a call to talk more. Otherwise, I appreciate you watching and I look forward to talking with you soon.